it's going to get harder and harder to predict what's going to happen because volatility is going to go up and up. But the dollar's coming down. People are going to be running away from the dollar, but trying to keep their dollars. So there's going to be a lot of hedging going on, and there's going to be a lot of stuff happening. Gold heading towards 5,000, silver heading towards $100 an ounce, and to be honest with you, it's scaring the living daylights out of me.
Gold and silver markets are moving with a level of intensity not seen in decades. The dollar is weakening, volatility is surging, and investors are flooding into hard assets for protection. From fears of a government shutdown to Treasury liquidity injections and bond market distortions, multiple factors are creating a perfect storm for the precious metals market. Gold's recent breakout isn't behaving like a steady 45-degree climb, it's going vertical. That's the hallmark of a bubble, or, more ominously, a crisis-driven rally. As nations hoard gold for war, global investors are waking up to what central banks have known all along. Gold is not just a hedge, it's insurance against global instability. Silver, the faster and more volatile retail metal, could soon follow gold's explosive path, with many analysts now eyeing $100 per ounce as a realistic target. ClemChambers, CEO of ADVFN and a veteran market analyst, believes this rally may not be driven by optimism, but by fear. He warns that gold at $5,000 signals deep-seated systemic problems, potentially leading to geopolitical conflict or financial collapse. Yet as panic buying and retail FOMO grow, silver may outperform gold dramatically in the coming months. Now, we present the clips from ClemChambers' interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
When you're in a rally, it goes at sort of like a 45-degree. When you're in a boom bubble, something bad's happened, it goes vertical. It's going vertical. And if you plotted gold from when I went, oh, look, it's broken out, which was 2000, whatever it was, I'd expect it to go at 45 degrees, not at vertical. And so, I would say I would be looking at gold to be at 5,000 by the end of the Trump administration. Well, it could be by Christmas at this rate. So if you think, and I've been saying it, my theory is gold is for war. That's why countries keep it. All the countries are buying it to put it in their warehouse just in case the worst happens. That makes the price go chunk, 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 chunk. Well, the moment it does that, either other things are happening which you haven't thought about, or bad things are on the way. So that's why I'm not very happy at the moment, even though I'm coining it. So the only thing is, David, is that you could think about the US government shutdown. That makes them worried that the dollar will be going down. That it's all sorts of reasons to run for cover. And you run for cover in precious metals. And so that's one way of explaining it. But, America's gone through shutdowns on numerous occasions before, and they're not really shutdowns anyway. They still pay the Social Security. The soldiers still march. Most of the offices are still open. Yes, Smokey Bear in Yellowstone has had to, take a day off. But, it's not such a massive big deal because it's happened so many times now. So you could put it down to that. Now, what you can also put it down to is the Treasury is obviously printing like crazy, and it's doing it because it held back cash before the shutdown, because it always does, because it saw it coming, and you don't have to be a genius to work out it was. And then it flushes the system with cash. It's also, if you look at the bond curve, looks like they're monetizing the short end, i.e., when a short-term bond comes up, they're not replacing it with a new bond at the short end. They're just handing out cash, and the cash goes into the system. The banks literally have a real-time feed of seeing that money coming down the pipe, and they take it and give it to people who want to put it into risk assets, and they do it themselves as well. So that puts a bit of upward pressure on things like gold, things like silver, things frothy assets like Bitcoin, and the stock market, and you're seeing that. So you can put it down to that. And finally, rather than the four horsemen of the apocalypse, you could put it down to retail FOMO. Now retail is getting FOMO because the price has moved so far. The sort of people that say, oh, my next door neighbor bought a new car because he had silver and he bought it at, $2 an ounce and sold it at 45. Oh, I need some of that action. And that FOMO, which is the curse of the private investor often, because, they have short-term joy and then have long-term grief. That FOMO, I think, is now starting to be underway, but it could run a long, long way, that. So anyway, I like to draw my voodoo lines on the chart. And originally I saw $3,500 because in that breakout I did my voodoo and it said $3,500, and a few months went by and I did a bit more voodoo and it said $4,500. And now it's more like $5,000. And so yes, I see a top at 5,000. But if gold is for war, gold at $5,000 is a pretty scary signal. But yes, I mean, another thought is, what if gold is at this price now? And most people aren't even thinking in those terms. Yeah, I mean, there's terrible things going on in the Ukraine. Yeah, Pakistan and India had a bit of a punch up. Yes, it's pretty awful in Israel and they blow up Iran and all that. But it's not the big one. And the big one is US versus China. And not everything you're seeing is US versus China. Well, what's the price of gold then? I mean, it doesn't. I can't even wrap my head around that one. So you've got this situation where it could really, 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 really run, but then you're getting into, a fog of the unknown that is so thick. It's very hard to guess what to do. And right now it's just running hard, and I literally spent a large chunk of this weekend. I'm on holiday in Greece, but I still spent a large part of this weekend trying to work out other explanations for these fast price moves, these fast markets. That wasn't something awful. And that the three things I said earlier were the best that I could come up with. And it's still not satisfying to me. I look at silver as the fast horse. Okay. So, gold starts to move and everyone goes, well, what's going on there? I don't understand. Gold's going up, gold's going up. I don't understand. Oh, maybe central banks are buying it. Maybe countries are buying it. Oh, well, that's interesting. Whoa, maybe I need to buy some gold. Oh, gold's going, going, going. Oh, what about silver? What about silver? Oh, it hasn't really moved much yet. I think I'll buy some of that. Oh, that's bound to follow gold. And in they go. And then you get the momentum up. And once the fast horse is running, it's running. And it's also what I call it retail gold. Yeah. Because if you're a normal Joe and you think, right, I want to buy silver, well, you can obviously go in the market and buy it as ETFs. And that would be a sensible thing to do. But a lot of people go down a coin shop and they'll go, show me some gold. And they'll look at this tiny little bit of gold and they'll go, oh, look, that's quite expensive. Show me some silver. Oh, like I get a sack for that. I get it's only 50. I can get, oh, yeah, I can get best part of 80 of those coins for the price of one of those gold ones. I'll have that. Give me a sack of silver. That sounds good. So it's more the retail. And of course, retail is much more frothy than institutional. So when silver starts to run, it runs fast and it also can run more. So you could see gold go another $1,000, say, for example, and then see silver double. And so, in a sense, if gold started to slow, if you wanted to play the trading game, you'd flip into silver and see if it carried on running because it's quite capable of running after gold stopped. Because, B to G, business to government, that's gold. B to C, that's silver. And then, if you want to look even further down into the land of obscurity, you've got platinum and palladium, which used to be 1 to 1, and they're like 3 to 1 at the moment. I mean, is it three? Yeah, roughly 3 to 1. Maybe not 3 to 1, two and a bit to 1 to gold. So they could double just to get parity with gold. And so, you've got all these different variables going on like crazy. I mean, another one to think about is, I mean, silver is thought of as very important with the AI revolution, but stop and think about how much is made. 3,200 tons of gold, 25,000 tons of silver. That's 8 times. Well, if silver was 8 to 1 to gold, that would be a wonderful world. Unless suddenly peace breaks out and Donald gets his Nobel Prize, it's going to go way further. I mean, if gold just keeps trundling, well, it's not trundling. If gold keeps going the way that it's going, or even if it slows down and starts to trundle a bit, silver's going to go quite a long way past this. And I mean, does anybody think it's not going to go smashing through 50? I mean, why wouldn't it? I mean, you could say, well, gold is toppy now. You could make an argument for that, and I wouldn't, but you could make an argument for that. Oh, gold's had its run, it's all good, and it's not, it's enough. But it's quite difficult to do so. But if gold just continues to do what it's doing, even at the 45 degrees rather than the 90, silver will run and run and run. And $100 is I mean, I thought $100 was a stretch only a few weeks ago, but now it seems to me to be a reasonable projection, a reasonable destination, not a dead cert. I mean, $50. Now that's looking like a dead cert. Didn't look like a dead cert 3 weeks ago, did it?
The global markets are entering a critical phase where policy, technology, and geopolitics are converging into a powerful economic storm. Interest rates in the US are heading lower as the government aims to reindustrialize and boost domestic production, which will inevitably push the dollar down. That combination, lower rates, higher inflation, and a weaker currency, creates fertile ground for both a boom and a bubble. Gold and silver are responding sharply, while defense and technology stocks are beginning to reflect the realities of a world shifting toward conflict and rapid innovation. Meanwhile, the AI revolution is being compared to the steam engine era, setting the stage for massive wealth creation and destruction. Commodities like copper, vital for server farms and infrastructure, may become strategic assets as this transformation unfolds. Let's get back to the interview.
People like the Treasury and the Fed have as much control over it as they want to have until suddenly they would lose all control. But that's miles and miles and miles away. And they can bend that curve and they can twist that curve as much as they want. And they will. Again, interest rates are coming down in America, and therefore bond yields are going to go down and bond values are going to go up. That's and the dollar is going to go down. Because if you think about you've got to be a Trump whisperer, God forbid, and he wants to reindustrialize America. He wants to bring it all back home. He wants MAGA and all that stuff. Well, that means having a more competitive basic set of industries. And for that, you need a weaker currency. And for that, you need lower interest rates, right? So people can borrow money and build factories and build shipyards. Well, so lower interest rates, higher inflation, weaker currency. And that's how you get a very quick acting boom. That's the old fashioned boom bubble economics. And that's what America's going to get. And a lot of people are already running from that. And you could say that's why gold is running, because it's all about the dollar. Well, when you think it's all about competing with China, not necessarily in a very friendly way, then you've got the second string of gold going up, which is gold is for war. So you've got these two horses of the apocalypse running. And, you're starting to see disruptive markets appearing. I'm going to start sweating if it gets into the 4,500 plus zone, and I'll be hanging on, I think. And if it goes through 5,000, the more it goes up, the more I'm going to be sweating when it's near 5,000. Okay, so trees don't grow to the skies, as they say, which doesn't mean a great deal, but it means that things don't go up forever. And I always get out, not at the top, not over the top and back down the other side, but normally about 2/3 of the way up. So if I get out of 5,000, it's going to 8. But I'm worried about the velocity of this move, not about the number. So I'm cool with that. I mean, I am now, I think, moving into American defense stocks because they look like they're starting to run. And the defense stocks in Europe have run, and in the UK they have run. And if you look at Lockheed Martin, its recent performance since say August, oh, that's an interesting looking chart. I mean, you don't often see stocks do that, what it's doing, which is not a big move, but it's just going accelerate. And that's what I look for in charts. I look for accelerations, and certain patterns do certain things: up like a rocket, down like a rock, accelerate. Just keep going up like that, smooth as silk. All those sort of things. And I look for those patterns because they tell you about the underlying dynamic driving that market. Well, if you look at Lockheed Martin, I think they pay a 2.5% dividend. I mean, give me a break. Yeah. And they're on an 18 PE when the S&P is on 28. Give me a break. And all of a sudden, and everybody's shouting at everybody. And now China's helping Russia fight the Ukrainians, and America's going to send cruise missiles, maybe, maybe not. Oh, blah, 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 blah. And then your defense stock starts to do that. Server farms in space. Yeah, well, I mean, yeah, he's also right. Now, what he said about that is that this is a dot-com bubble too. However, what you have to think about is what year? 2001, 2000, 99, 98, 97, 96, 95. It's somewhere in there. And I think it's probably got a year or so to run, maybe more. I mean, the thing about the internet, that was a big deal. Okay, a big, big deal. But AI is 10x that. It's so much more of a big deal. I was one of those internet.com successful .com boomers. I mean, I had a dot-com boom company that went from, 10p to £2.50 in 4 days. So I know all about that run. And he's right. There will be mass casualties in the AI field. And out of that will come absolutely Goliath companies for sure. That's absolutely going to happen. However, where are we? If we're in the end of 1999, you want to be selling. But if it's 1997, there's a long way to go. And again, we're not in a vertical in the NASDAQ. A bubble goes vertical, like gold looks right now. Gold looks quite bubbly. Yeah. It goes up, it breaks up, it starts to go crazy, and then the final part of it is absolute vertical. I don't think we're in the vertical yet, but I think we're probably in the beginning phase of we're no longer in a boom. We are now at the beginning phase of a bubble, but it could be 18 months, could be 18 weeks. It's certainly not going to be 18 years. I think that it's going to get harder and harder to predict what's going to happen because volatility is going to go up and up, but the dollar's coming down. People are going to be running away from the dollar, but trying to keep their dollars. So there's going to be a lot of hedging going on, and there's going to be a lot of stuff happening. Okay, let's put it another way. The US versus China is a big hairy deal. Work out for yourself what's going to make you money there because you might need it when you head for Chile. And then the other one is AI is a massive, 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 big hairy deal. And if you can pick up the right winner, the right area that no one's thinking of, and there's loads of them out there right now, you can stake them out and get in early and you'll make a fortune. Let me give you an example. I mean, well, copper is a perfect example. There's just not enough of it. But what about people that make copper cables? Is that a good investment or a bad investment? And I was looking at all the big cable makers that make cables for server farms. The trouble is, obviously, they're going to have to buy copper. And they're going to have all these orders and copper's going to go for the roof. So the margins are going to go like that. So maybe not a great investment. So, there's going to be demand for commodities, strategic metals like there's never been before. There's going to be demand for certain things that are just going to spin people's heads. They're going to boil the oceans. So what assets, what companies do you want to be long of? Because nobody knows totally yet. And the full implications of this is only starting to dawn on people. And it's just such a massive thing. It's like when they invented the steam engine. It's like that, but it's also going to be at an accelerated pace. The big stocks in the good old days were the railway stocks. It all came from the steam engine, steam power, railways. Railways was massive. The Vanderbilt fortune was built on the back of it, for example. And that is the situation we're in now. There's been a moment of a breakthrough in science and technology, which is AI. And that is going to do for humanity what artificial muscle did for us. This is artificial brain, which is a 10x for that even. So it's a 10x and a 10x. It's like, that's what you've got to be focusing on, finding things that will be on that rocket ship. Copper is one.
We're entering an era where the dollar's dominance, industrial revival, and the rise of AI are converging to reshape the entire global economy. The US is entering a deliberate phase of currency weakness, driven by lower interest rates and reindustrialization goals. Gold, silver, and key commodities are reflecting this shift with violent upside moves, while defense and tech stocks are quietly preparing for what's next, a world defined by strategic competition and exponential innovation. At the same time, artificial intelligence is becoming the modern equivalent of the steam engine, a force capable of rebuilding industries and rewriting value chains. From copper producers to server infrastructure, the real winners will be those positioned before the acceleration begins. Volatility is only the surface expression of something more profound. The markets are moving faster than most realize, and missing this cycle could mean missing one of history's great wealth transfers. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.